Today I want to talk to you about the least fair tax that exists on the Irish statute books today, and that's inheritance and gift tax. Now, those of you who follow me will know I'm not a big fan of this tax, and in this video I want to tell you a bit more about the history of it. I want to tell you about the rates and why the rates are higher today in reality than they've ever been. And I want to tell you eventually the 9 different ways that you can use to legitimately avoid the tax. But before I do, let's give you a bit of history. This is a relatively new tax, introduced 50 years ago. And 50 years ago, as unfair as it was, it's even more unfair 50 years later. Why? Because the tax-free thresholds, the amounts we can leave to our children or our family or our mates, hasn't increased, I beg your pardon, in line with inflation. So to choose one of these thresholds, the biggest one, they call it a Group A threshold, at €400,000 today, having been increased last year for the first time in 14 years. That threshold should be closer to €570,000 if it had matched inflation since this tax was introduced. So gift and inheritance tax, to give it its proper name, capital acquisitions tax, covers both gifts and inheritances, and the rate is the same and the thresholds are the same, whether it's a gift or inheritance. To tell you those thresholds, to be exact, Group A threshold, parent to child, €400,000 tax-free. Group B threshold, blood to blood, €40,000 tax-free. Group C threshold, stranger allowance if you like, €20,000 tax-free. Beyond knowing what the tax rates are and the tax-free thresholds are, which, let's face it, you could Google in 10 seconds flat and get for yourself, the other thing I want you to be aware of is on gifts and inheritances, not only does this legislation interfere, but another major piece of legislation also interferes, and that's called the Succession Act. The Succession Act is on the statute book since 1965, so it actually predates capital acquisitions tax. But it still interferes. And how it interferes is granting specific rights to specific people. It grants spousal rights. It grants children's rights. It grants other rights from time to time. And the point I want to make to you, whether you're a person deciding on gifts and inheritances that you're going to give, or whether you're a person on the other end of that receiving gifts or inheritances, is that your wishes are not without statutory interference. These people who are granted rights under the Succession Act have a right to sue your estate or later on if they feel they haven't been fairly dealt with. The other thing I would like to draw your attention to when I say it's unfair is the tax take of this state for this tax. Back in 2014, 10 years ago, plus a little bit, the tax take was €356 million. The tax take in 2024, 10 years later, €854 million. This is €854 million the state has taken from those people giving the gifts and or those people receiving the gifts. And bear in mind that those people giving the gifts paid a whole bunch of taxes as they accumulated these assets in the first place. That's why I believe it's unfair. This is a tax on after-tax assets and should be eradicated in my view. But while it isn't, and I'm not sure I can see a way where any government we can envisage in the future would remove this type of tax. But while it isn't, the other thing I want to make you aware of is there are many legitimate ways to remove or reduce this tax. And in this video, we will tell you some of those ways. Finally, to go back for a second to the amounts of tax been taken from us by the state, one of the reasons the increases have happened is the reason I mentioned, indexation, that the thresholds aren't increasing in line with inflation. Another reason is the tax rates themselves have gone up. I remember well when the inheritance and gift tax rate was 20%, it's now 33%. And the other reason is the same governments who have increased the rates have taken away exemptions. There used to be, for an example, a thing called indexation relief, where you could raise the asset value with indexation before you calculated gift or inheritance tax. So the most unfair tax on our statute books, the tax rate that has increased exponentially since its introduction, and both of those reasons should incentivize you to use every legitimate way of reducing the tax liabilities. So let's look at those. So let's talk about some of the major reliefs that can be used to lower inheritance or gift tax liabilities. Relief number 1, dwelling house relief. Relief number 2, agricultural relief. Number 3, business assets relief. And number 4, exempt assets. So let me put a bit of meat on the bones there. Dwelling house relief. This allows a house to be given to an individual, either through gifts or inheritances, tax-free. Now there are qualifying criteria, as there are in all these reliefs. Qualifying criteria for dwelling house relief includes that the house being given must be the principal private residence of the giver, of the donor, that the individual receiving must have lived there for 3 years at least, that the individual receiving must keep the property for 6 years afterwards to maintain the relief, and that the individual receiving cannot have a share or own another property, a share in or own another residential property. They can own or have a share in commercial property, but not residential. So that's dwelling house relief. Agricultural relief, broadly speaking, reduces the value, the inheritance value of the asset to 10% of its normal market value. But to again receive it and get that relief, they have to be agricultural assets as defined in the legislation. The recipient must hold them for 6 years to maintain the relief. And once they get these assets, the recipient must have 80% or more of his or her assets being agricultural. So you don't necessarily get it for having wellies on and milking cows. There are other qualifying criteria. The third one I mentioned, business assets relief. Basically agricultural relief for those in private business. Similar to agricultural relief, it allows the transfer of business assets at 10% of their nominal or market value. Again, as long as the recipient keeps it for 6 years beyond the date of gift or inheritance. And finally, exempt assets. From time to time, the state will exempt certain assets from tax, generally to incentivize people to purchase these type of assets. Today, that means art on public display, or assets that are of significant interest to the state. It means heritage property, and in many cases it means forestry too. And what I mean by many cases is basically forestry is agricultural relief, but without the 80% rule. So let's go back for a second. Dwelling house relief. You may think that just because you've lived in a house for 3 years you can get it tax-free. But that's not necessarily the case. Because if that isn't the principal private residence of the donor, or that is a house you're getting when you have interest in another house, you wouldn't get the relief. Agricultural relief, you may be a farmer, but if you have lots of other assets and you don't achieve the 80% rule, then you don't get agricultural relief, business assets relief. You may get it, but what will the business be worth in 6 years' time if the main driver of that business, who is the donor, is gone? So having the relief may be no use to you because you have to sell it to maximise value. And exempt assets may or may not be exempt in the future. All you can do is choose those assets based on the rules and regulations and review your structures from time to time. So while anybody could read out to you how these reliefs, anybody can tell you what the reliefs are by Googling it, as I said earlier, but only a truly professional financial planner who understands these reliefs, who understands your circumstances, the donor's circumstances, the beneficiary's circumstances, only they can help you manipulate your financial world to qualify for as many as possible. And these aren't an exhaustive list, by the way, guys. I've just chosen the top 4 here. There are others that may or may not apply depending on your circumstances. So, they're the exemptions. But of course, and it won't surprise you, especially if you've heard me before, to hear me say, it ain't what you do, it's the way that you do it. Anybody, as I said earlier, can read you the exemptions. But applying those exemptions to your world, or manipulating your world to apply or to qualify for those exemptions, is what the planning is all about. So, what strategies might a planner employ or help you to employ to lower tax liabilities? Well, strategy number 1 may be gift it now. One of the things that you can do by gifting now is stop the ever-increasing rot. I mentioned earlier that tax-free thresholds are lagging behind inflation, which means that if your assets are growing at inflation or above inflation, then the gap between the tax-free threshold and the amount of your wealth is growing every single year, which means that the taxes liable eventually when you give away these assets, be it in life or on death, is growing every year. So you can stop that rot by gifting the asset now. Now, when I say this to people in the real world, they often say, they laugh at me and go, I'm not giving away assets to the kids now. Sure, they're too young, they're too inexperienced. But that, of course, that objection presupposes that giving away assets means giving away control. But it doesn't. Whether it's family partnerships, whether it's trust funds, whether it's shareholdings in private businesses, voting rights shareholdings, it is possible to retain control over assets and still transfer the legal ownership. So, just to give you an example, let's say you have an asset worth €400,000 and you are about to give that away, or you plan to give that away to one child, which means based on today's value and today's tax-free threshold, that gift or inheritance would be tax exempt. But let's say you don't give it away, the tax-free threshold remains the same, because it's remained the same for the last 14 years prior to the last year's increase, and the property goes to 500,000 in value. That's a tax of 33% of the 100,000, 33 grand. If it goes to, over time, 700,000 with no tax-free threshold increase, the tax goes to 100 grand. If it goes to £1,000,000 over a period before there's a tax-free threshold increase, the tax goes to 200 grand. That's the same property being transferred to the same individual with a tax liability ever growing because you failed to give it away in 2025. So, there's the potential benefit to your estate and to your family. Now, of course, gifting assets now isn't always the right thing to do because it depends on the asset. Gifting an asset today is a disposal. So that means that take that same 400,000. If that 400,000 is a share portfolio that you invested 300,000 in 10 years ago, by you gifting it away at the value of 400,000, that would incur a capital gains tax liability for you of 33% of 100 grand, which is 33,000 euro. So the cost of giving it away in that example is 33,000 euro. I'm not saying you should or shouldn't do it because of the cost, but what I am saying is you need to take the cost into account. You need to compare the costs, which aren't only any tax you might pay, but also conveyancing costs, also stamp duty costs if it's a property or shares. Take those into account. Run your numbers. Let arithmetic be your guide. One of the key assets that works very well in this give it away now strategy is the home. And the reason it works well is our homes are tax exempt. It doesn't matter what you paid for the home when you bought it first. And giving it away today, there will be no capital gains tax on the disposal. Now, going back to Ain't What You Do the way that you do it, and I mentioned earlier, there's ways of giving away assets while you retain control. And one of the most useful ways is what is referred to as a family partnership. A family partnership is a legal structure where you and your spouse, usually if you're the donor, become the managing partners. But the predominant beneficiaries of the partnership are your children or your heirs if they're not your children. So it allows you to give away assets today through the partnership, but retain control as managing partners. When I talk to people about this, I say, think about AIB and think about the board of AIB. The board of AIB controls AIB, don't they? They decide on who's hired and fired. They decide on bonuses. They decide on pension contributions. But do they own AIB? No, they don't. AIB is owned by tens of thousands of shareholders. So there's a divorcing of ownership from control in AIB, and there's a divorcing of ownership from control in family partnerships. The other thing that's important to note is that giving away assets, as I said earlier, run your numbers, or maybe get somebody to run those numbers for you, like an impartial financial planner. But one of the things I must say to you is that timing may well be vitally important here. Giving away an asset, take the dwelling house relief. Let's say you have 4 children, you have a valuable home, but only one of those children is living in the home today. Only one of those children doesn't have an interest in another residential property. And that child may well move out of the home relatively soon and get an interest. So that means that for you to claim dwelling house relief on this asset for that child, you need to do something now. Not in a year's time or 2 years' time or 5 years' time when they've moved on, they've bought their own home and they no longer qualify. And doing that through the family partnership structure I mentioned allows you to maintain control. Even though you've moved the ownership, you control the asset. You decide on when it's sold, if ever. You decide on if it's mortgaged or not. You decide everything. So timing, gifting now is suitable for some assets. It may not be suitable for other assets because of the disposal and capital gains tax you might have to pay. And ultimately, the tax that the beneficiaries will pay is, as I've already stated in terms of the thresholds, is dependent on their relationship with you. Children, which by the way includes both stepchildren and foster children, are in the Group A category and get the 400,000 tax exempt, if that's what you leave to them. Spouses get 0% tax, but even spouses who perhaps are separated from each other but not yet divorced, be aware of the spousal guarantee under the Succession Act, which is 1/3, even if the will says they get nothing. Also be aware, in the horrible event that you've lost a child, but that child was married, is that the child's spouse and or the child's children have step-in rights to the Group A threshold that the child would have had. So maybe you can use that. And finally, make sure that you use all familial allowances. Not only do you have children, perhaps, who can get 400,000 tax-free, but if you have grandchildren, they can get 40,000 tax-free. So let's say you have one child, you're giving away 480,000 worth of assets. You know that if you give all of that 480 to your child, they will pay 33% tax on the 80 grand. You give 400,000 to your child and 40,000 each of your grandchildren, and the tax drops to zero. It ain't what you do, it's the way that you do it. And financial planners who are experts in this field can help ensure that you do it the right way and pay as little tax as legitimately possible. So, there are different tax exemptions, there are different tax-free thresholds, there are different ways of planning to manipulate your financial world to qualify for as many tax-free thresholds as possible, for as many tax reliefs as possible. The last thing I want to talk to you about is death insurance. Now, most people call this life insurance. Let's face it, was called what it really is, which is death insurance. You know, few enough people buy it anyway. Nobody'd buy it at all if it was called death insurance. They call it life insurance. But basically, any insurance that is paid out when you die would be better named, in my view, death insurance. And there is a particular death insurance policy that can be very helpful where inheritance taxes are concerned. And this, of course, is about inheritance taxes, i.e. you're dead, and therefore a particular policy under Section 72, it's called a Section 72 policy, the proceeds of that policy are tax exempt if they're used to pay the taxes on the balance of the estate. Now, sometimes when I mention this type of insurance to people, they go, well, I got nothing. The kids, I got nothing when my father died. The kids can pay their own taxes. And that may well be, and that's perfectly reasonable if that's your view. But before you make that decision, let me tell you a couple of home truths about how inheritance tax is paid. Inheritance tax is paid in cash. So if beneficiaries inherit a lot of assets that aren't cash, they may have to fire sale those assets to get the cash to pay the tax bill. The tax bill is also paid, depending on when death occurs, somewhere between 4 months after the date of inheritance up to 16 months after the date of inheritance. So if it's the earlier one, kids or beneficiaries receiving assets can get a large tax bill from the revenue and have that be claiming the revenue, claiming that tax bill in a relatively short period of time. Not only can that put pressure on beneficiaries, but the revenue will add late payment penalties if that deadline is missed. So what we have in terms of the way tax is paid is it's due in cash, which if you have a large amount of cash to leave behind may well be very easy for your beneficiaries to pay. But in Ireland, the vast majority of Irish wealth, as we've seen in recent reports from the central bank, is contained in property. And property isn't very liquid. So you need to sell the property to pay the tax. Now, if the market understands you're selling the property to pay the tax, that you need to pay the tax in a certain period of time, that the liabilities will be rising exponentially if you don't hit those deadlines, then the market is going to take advantage. The market is going to go to your kids and say, I know it's worth £1 million, but you need the money. I'm giving you 800 grand for it. Take it or leave it. And if they take it, not only does that mean they've lost 200 grand in that example? But the revenue are unlikely to accept that the sales value was the inherited value. So the revenue will go, well, the asset was worth $1 million. The fact that you sold it for 800 grand is your problem, not our problem. We want the tax on the $1 million, even though you had to sell it for 800,000. So Section 72, in my view, is not about making the beneficiaries richer, although that might be a byproduct of its application. It is about making sure that liquidity is in the estate. Is it about making sure that taxes can be paid in a timely fashion? It is about avoiding fire sale and reduction in values. It's about avoiding late payment penalties, which under current rules are charged at 8% a year on a month-by-month basis. So, death insurance is something to be considered, especially if the estate you're leaving behind is illiquid. I often say to people when I talk about this, if I went to your kids, who are the beneficiaries, and I said to them, look, would you like mum and dad to pay away 0.5% a year, which is broadly speaking, and it is very broad, the cost of this type of insurance at ordinary rates for relatively young people, relatively young, 60 plus or minus 5 years. So would you like mum and dad to pay away 0.5% a year of your assets, of your inheritance, to save you 33% in tax? And the answer will be yes, please, because the arithmetic makes sense. I'm not telling you Section 73 is cheap. It's not cheap. What I am telling you, though, is it's extremely good value for money. The last quote I did before I took on this role and stopped selling insurance, I showed the donors, the parents, that they would have to live to 137 years of age to pay up for the premiums on the Section 72 to equal the tax that would be payable. Now, your assets, if you're the donor, your assets are going to pay the tax. The question is, do you pay it on the drip and reduce the cost, or do you allow the kids to pay it at the end and perhaps not only increase the costs, but increase the costs exponentially through loss in a fire sale and late payment penalties if they can't liquidate quick enough? That's up to you, of course. What I am suggesting, and Section 72 will be for some and not for others. Giving away assets will be for some and not for others. What I am suggesting is that if you want to pay as little of this totally unfair tax as possible, whether you're the beneficiary or the donor, have a chat with a fully regulated, proper financial planner. So, I didn't make this video to tell everybody who witnesses it or watches it that giving away assets is for you, that changing to exempt assets is for you, that splitting your assets between different children so they qualify for different tax reliefs is for you, that Section 72 is for you. I don't know. But what I am, the reason I did cut the video was to try give you new knowledge and new information so you can realize that tax, the inheritance tax or gift tax you and your beneficiaries, your estate and your beneficiaries will pay, is not cast in stone. You can reduce the liabilities through effective planning, but only through effective planning, and only through a financial planner that knows his or her stuff in this regard. If you don't have one, seek one out, because the benefits will be far more than the costs. Finally, for those of you who viewed this as a video on YouTube, I'd like to remind you that an audio version is available as a podcast. For those of you who've listened to this as an audio, I'd like to remind you that there's a video version on YouTube. And all of you, I'd like to remind you, please subscribe. And if you haven't subscribed already, please do so in the future, because that is the way that we can continue to bring you the type of information that we're bringing you now.